Picture the scene for a second. It's New Year's Eve, 2025.
Oh, right, the big night.
Yeah, exactly. Most of the world is, popping champagne, watching fireworks, doing the whole countdown thing.
Yeah.
But inside this one corporate office, a team of lawyers and financial executives are executing a completely different kind of countdown.
A much more stressful one, I'd imagine.
Totally. Over a single holiday weekend, they are literally dismantling their own company's charter. They're legally dissolving their identity as a specialized real estate lender, filing just a mountain of SEC paperwork, and waking up on January 1st as a completely different financial animal.
It's honestly the corporate equivalent of, like, performing an organ transplant while the patient is still running a marathon.
Right?
Because you are completely rewriting your relationship with your investors, your regulators, and your capital, all without halting your daily operations.
And that brings us to today's deep dive. Welcome in, everyone. Our mission today is unpacking the Q1 2026 earnings report, the earnings call transcript, and the investor presentation from AFC Gamma.
Ticker symbol NASDAQ AFCG for anyone following along.
Exactly. And these materials literally just dropped today, May 7, 2026.
Fresh off the press.
Very fresh. But for you listening, we're going to look at this not just as like a dry earnings report. This is a fascinating real-time survival case study because AFC Gamma built its entire Wall Street reputation as a pure play lender for the cannabis industry.
Right, that was their whole identity.
It was. But as of January 1st, they executed this massive shift to pivot away from just cannabis and into the vastly wider world of private credit. So, okay, let's unpack this. How does a niche financial company reinvent itself overnight?
It's a huge question.
Right. And what do their Q1 receipts actually tell us about whether this high-stakes maneuver is working?
Well, to interpret the numbers they just reported, we first have to look under the hood at what actually happened on that January 1st deadline.
Let's do it.
AFC Gamma transitioned from a real estate investment trust, which is a REIT, to a business development company, or a BDC. And I want to be clear, that is not just a branding update. It fundamentally alters how capital flows through the business. What's fascinating here is how the BDC structure fundamentally changes their entire playbook.
Let's break down the mechanics of that shift for a second, because, as a REIT, your entire existence is basically tied to physical dirt.
Literally.
You are effectively a highly specialized landlord or a mortgage holder. So for AFC Gamma, if a cannabis operator came to them and wanted capital, AFC could only write the check if there was like a cultivation facility or a dispensary to put a lien on.
Right, which works perfectly fine when real estate values in your specific sector are booming and operators constantly need larger physical footprints.
Sure.
But the legal handcuffs of a REIT structure mean you are entirely locked out of underwriting a company based purely on, say, its intellectual property, or its software, or its future cash flows.
You're just stuck with the buildings.
Exactly. But a business development company structure, which is governed by the Investment Company Act of 1940, completely severs that tethered to the physical dirt.
Okay, so it's like a mechanic trading in a highly specialized wrench for an entire multi-tool.
That's a great way to put it.
I mean, imagine having all this capital to deploy, but being legally blocked from making fantastic investments simply because there wasn't a warehouse attached to the deal.
Right. The BDC structure completely removes those handcuffs. It requires them to invest at least 70% of their assets in private or small public U.S. companies.
Which opens up everything.
It really does. They can now offer unsecured loans, convertible debt, equipment financing, revenue-linked loans, the works.
But the administrative burden of doing that over a weekend is just staggering to think about.
Oh, it's immense. We are talking about shareholder proxy votes, deregistering the old entity, setting up entirely new compliance protocols for non-real estate assets, plus completely altering their tax status.
Which brings up the most obvious question, I think. Why voluntarily subject your company to that level of operational trauma?
Right. Why go through the hassle?
Exactly, because the causal connection buried in this Q1 report is that they didn't just do this on a whim. The legacy cannabis portfolio is showing real signs of stress. They were essentially forced to pivot.
Yeah, the broader cannabis industry is just navigating this brutal intersection right now.
Yeah.
High taxes, hyper competition, and a very, very messy legal framework.
And the Q1 numbers really show the consequences of that environment on AFC Gamma's legacy book.
Let's look at those numbers.
Well, they did collect $41.2 million in cannabis loan repayments in the first quarter.
Which is great. Cash in the door is always good.
It is. But the filings outline some glaring issues. For instance, there's a borrower named Justice Grown that went into maturity default. and that just happened as of May 1st, 2026.
Right.
That loan is secured by vertical assets, meaning cultivation and dispensaries in New Jersey and Pennsylvania. And then there's another one, Debbie Holtz, which remains in receivership.
And for anyone unfamiliar with that legal state, receivership means a court has essentially appointed an independent babysitter to take control of the operations.
Basically.
The receiver's entire job is to either manage the business back to health or just liquidate the assets to pay back secured creditors like AFC.
And to be fair, they are actively recovering money from that process. They've pulled back $20.8 million from Debbie Holtz so far, with $6.2 million of that hitting just in this recent quarter.
Right, so the collateral works.
It does, but I have to push back on this whole narrative for a second, just based on what's in the news lately.
Oh, about the DEA?
Yes. We're seeing headlines everywhere about the DEA moving to reschedule cannabis at the federal level, taking it off Schedule 1.
Right, it's a huge topic.
So, wait, shouldn't federal rescheduling completely eliminate the massive 280E tax burden, like overnight?
Is the theory, yeah.
So shouldn't that save these cannabis operators millions of dollars and instantly make these legacy loans safe? Why panic and change the whole corporate structure if salvation is right around the corner?
It's a really valid point, and an analyst actually brought that exact assumption up during the Q&A portion of the earnings call.
What did they say?
Well, the CEO, Dan Neville, offered a very sobering reality check. And, looking at this impartially, just focusing on the business mechanics, yes, rescheduling eliminates 280E liabilities.
Right.
And that could absolutely boost asset values over the long term, which helps AFC recover money if they have to liquidate a defaulted loan.
Okay, so their tax bill technically drops.
Technically. But Neville pointed out a really harsh cash flow reality. Outside of maybe one major player, like GTI, most cannabis operators weren't actually paying their taxes anyway.
Wait, really? They were just ignoring the IRS?
Essentially, yes. They were bleeding so much cash that they chose to keep the lights on and pay their employees rather than pay their federal tax bills.
Oh, wow.
So if a borrower has been surviving by just completely ignoring a massive tax liability, removing that tax doesn't suddenly infuse them with new daily operating cash.
That makes total sense. The federal government stepping in and saying, you no longer owe us this money, doesn't actually deposit a single new dollar into that company's checking account today.
Exactly. Their post-280E cash position is functionally identical to their pre-280E cash position.
Which completely explains why AFC Gamma couldn't just, sit on their hands, hold on to their REIT structure, and pray for DEA rescheduling to save the day.
Right. They desperately needed the capacity to find new, healthy yield, and they needed it outside of the cannabis sector.
So since cannabis is so hyper-competitive and legally messy, they take this shiny new BDC multi-tool and they aggressively target a very specific new sandbox.
The lower middle market.
Yes, the lower middle market private credit sector. Let's define the parameters of that sandbox because it's super specific.
It really is. They are targeting cash-flowing businesses with between $5 million and $50 million in EBITDA.
And for anyone who doesn't live in spreadsheets, EBITDA is just earnings before interest, taxes, depreciation, and amortization. It's basically a company's raw operating cash flow.
Exactly. And AFC reported they have a massive active pipeline right now, over $1.5 billion looking for capital in this exact tier.
But here's where it gets really interesting to me. If this market is so incredibly lucrative with all these healthy cash-flowing companies, why did all the massive private credit platforms just leave it behind?
It's a great question. Chairman Len Tannenbaum synthesized this beautifully on the call.
What's his take?
He explained that the big mega funds, the ones managing tens of billions of dollars, experienced a slowdown in net inflows recently.
Meaning less new money coming in from their own investors.
Right. So when capital gets slightly constrained, these giants have to make a defensive choice. They shifted upmarket to support the massive companies already sitting inside their portfolios.
Oh, so they basically circled the wagons around their biggest borrowers.
Exactly. And by doing that, they created a massive capital void for the smaller $5 to $50 million companies.
Wow.
So if we connect this to the bigger picture, AFC Gamma is stepping right into this void. And because capital is suddenly so scarce here, they're demanding excellent terms.
I mean, it's basic supply and demand, right? If you're the only one with a checkbook, you set the price.
Precisely. Yields in this space are 100 to 300 basis points higher than they were just 6 months ago. AFC is targeting low double-digit yields overall.
So an extra 1 to 3% in pure interest just for showing up.
Yeah, but it's not just about the interest rate. Plus, AFC is demanding incredibly strict covenants.
Covenants being the legal rules written into the loan?
Right. They're demanding actual cash flow measures and fixed charge coverage ratios. They are flat out refusing to accept the covenant-like deals that plague the upper market.
Oh man, the upper market deals are wild right now. They accept those super aggressive EBITDA add backs.
Oh, the add-backs.
I always find those to be peak financial mental gymnastics. The borrower is basically like, look, our actual earnings this quarter were terrible, but if you add back the hypothetical savings we promise we'll get from a software upgrade next year, we're crushing it.
And upper market lenders actually tolerate that fictional math to win the massive deals. AFC Gamma doesn't have to.
Right, because they have the leverage. So walk me through that fixed charge coverage ratio. How does that strict covenant actually protect them?
It's essentially a ratio that measures a company's ability to pay its unavoidable bills. So, say a business generates $100 in cash flow a month.
Right.
And their mandatory debt payments and leases total $50. The ratio is 2 to 1. AFC will write a strict rule saying that if that ratio ever drops below, say, 1.2 to 1, it triggers an immediate technical default.
So it functions as an early warning tripwire.
Exactly. AFC doesn't have to wait until the company's bank account literally hits zero. The moment the safety margin shrinks, AFC can step into the boardroom and demand changes.
That is brilliant. It's such a structural advantage. Find cash-flowing businesses neglected by the big funds, charge a premium rate, and lock down the downside.
It's a great playbook.
It is. But, a strategy sounds brilliant in a slide deck. The real question is, what does this actually look like in practice?
Right, we need to see the actual deals.
Exactly. What did AFC Gamma actually buy with their freshly expanded $80 million credit facility in Q1?
Well, they didn't waste any time. They closed 2 major non-cannabis loans totaling $90 million in Q1, plus another $5 million funded right after the quarter ended.
Let's look at the first one. It's called Stat Buyer, LLC. AFC provided a $60 million facility for them, and Stat operates in the revenue recovery business.
Right.
I was totally geeking out over the math the CEO laid out for this one on the call. Stat helps suppliers recover unjust deductions from massive big box retailers like Walmart.
The scale of that is just hard to wrap your head around.
It really is. So let's use Walmart as the example, just like they did on the call.
Okay.
Walmart does roughly $700 billion in annual sales.
Okay.
And the cost of the actual goods they sell is around $400 billion. Now, as suppliers submit invoices for that $400 billion, Walmart software typically deducts about 2% across the board for minor errors.
2%. That doesn't sound like much until you do the math.
Exactly. A 2% deduction for, like, a pallet having the wrong barcode or a truck being 20 minutes late. But 2% of $400 billion is an $8 billion recovery opportunity pool.
Just massive.
$8 billion in withheld cash, just sitting there. Stat steps in, acts as an auditor, proves which deductions were completely unjust, and recovers that cash for the supplier.
And then Stat takes a cut of the recovery.
Yep. AFC Gamma just financed a business with access to an $8 billion recovery pool in the Walmart ecosystem alone.
And think about this. Stat relies on software and auditing expertise. There's no physical real estate to put a lien on.
Right.
So under their old REIT structure, AFC Gamma legally couldn't have touched that $60 million opportunity.
Wow, that really puts the transition into perspective, the multi-tool in action.
Exactly. And the second major loan follows a very similar logic.
Right. BCIS AH borrower. It was a $30 million commitment with $20 million funded in Q1.
What's the business model there?
So BCIS is a healthcare benefits platform, but they specifically offer low-cost virtual urgent care and generic prescriptions tailored to low-wage hourly employees.
Which is a huge demographic that usually gets ignored by corporate health plans.
Totally. Standard plans are just way too expensive. A healthy 24-year-old working retail isn't going to pay hundreds a month for a platinum plan, so they just opt out.
Right, they just go uninsured.
Exactly. But BCIS strips the insurance model down to just what they actually use. It's super affordable, so participation rates are really high. But the true genius here, the reason AFC loves this business, is the mathematical benefit to the employer.
Walk me through that. How does the employer save money?
Okay, so when an employee signs up, the monthly premium is deducted pre-tax. Let's say it's $100 a month. That instantly lowers the employee's taxable income by $100.
Okay, tracking so far.
Well, the employer is legally required to pay a 7.65% FICA payroll tax on all employee wages, because that $100 is no longer counted as taxable wages.
The employer doesn't pay FICA on it.
Exactly. The employer saves $7.65 per enrolled employee per pay period. When you scale that across thousands of retail workers, the tax savings actually exceed the cost of offering the program.
That is incredible. The service literally pays for itself through federal tax efficiency while giving uninsured workers vital health care.
It's brilliant. It's a rapidly growing, highly profitable middle market company. And again, it's secured right into AFC Gamma's new BDC portfolio.
Which is just a textbook execution of their new strategy. But, transitioning corporate structures and writing complex loans is impressive. Ultimately, though, the market only cares if it translates to the bottom line.
Did the metamorphosis actually work?
Right. What's the financial payoff?
Well, the numbers say yes, absolutely yes. Net investment income, or NII, came in at $4.8 million, which is 21 cents per share.
Solid.
But the actual earnings per share, the EPS, absolutely crushed expectations. They posted 49 cents per share.
Wow. What was the Wall Street consensus?
The consensus was only 16 cents.
So they beat expectations by 33 cents.
Yes. It was a massive beat. And we also saw the net asset value, the NAV, increase. It went from $7.46 per share at the end of last year up to $7.90 per share this quarter.
That's a really healthy jump in NAV.
They also paid a 5-cent dividend. But maybe the most interesting capital move is that the board authorized a brand new $5 million share buyback program.
That is a fascinating move right out of the gate.
Let's talk about why a board does that.
Yeah.
Because if the company's underlying net asset value is $7.90 per share, but the public stock market is trading their shares at, say, $6,
the board can just step in and use the company's cash to buy back their own stock.
Exactly. They are basically buying a dollar's worth of actual value for 75 cents. It instantly increases the proportional value for all the remaining shareholders.
It's a highly flexible tool.
Yeah.
And it sends a very clear signal to the market.
What's the signal?
It tells investors that management believes the stock is currently undervalued relative to how well this BDC pivot is working. And they're perfectly willing to step in and buy shares if the public markets fail to price them correctly.
So let's bring this all together. What does this all mean for you, the listener?
It's the ultimate takeaway.
It really means you are looking at a masterclass in corporate agility. Think about it. The ability to look at a struggling core market cannabis, legally restructure your entire company over a holiday weekend to become a BDC, and then ruthlessly exploit a macroeconomic blind spot left by larger competitors.
It's brilliant capital allocation.
It really is. They took control of their own destiny in the lower middle market.
And, this raises an important question, a really provocative thought to mull over as we wrap up.
Hear it.
As these massive private credit funds continue to chase mega deals and they keep accepting riskier, covenant-light terms with giant corporations, are we going to see a renaissance of nimble microlenders like AFC Gamma?
Oh, that's a fascinating angle.
Right? Lenders who actually hold all the cards and demand strict protections.
Yeah.
It makes you wonder, where else in the modern economy is the quote-unquote boring middle market being entirely ignored by the giants?
Just sitting there waiting for smart capital to step in and set the rules.
Exactly.
That is definitely something to keep an eye on. And it's a great place to leave it for today. Thank you so much for joining us on this deep dive. Keep looking for the hidden opportunities in the numbers, and we'll see you next time.